What if gold's recent rise was not a short-term reaction to uncertainty, but a longer reallocation of trust that began years ago? At first glance, gold's advance appeared conventional. Prices began climbing in 2022, accelerated through 2023, and extended into 2024 and 2025, reaching new nominal highs. Commentators attributed the move to familiar explanations: inflation concerns, geopolitical conflict, or volatility in risk assets. Gold, after all, has historically responded to such conditions. But this rally did not behave like previous cycles. Rather than spiking and retreating, gold moved steadily as confidence shifted incrementally across the financial system. Volatility remained relatively contained compared to past crisis-driven surges, suggesting accumulation rather than speculation. By the early 2000s, global monetary credibility was under strain. Public debt in advanced economies reached levels last seen during wartime. U.S. federal debt surpassed 120% of GDP, while interest costs alone became one of the fastest-growing budget items. Central banks raised interest rates aggressively in 2022 and 2023, only to encounter a structural ceiling imposed by debt servicing burdens, financial stability risks, and political resistance. Rate cuts were delayed, but normalization proved difficult to sustain. Against that backdrop, gold demand changed in character. Beginning in 2022, central banks became net buyers at the fastest pace since the end of the Bretton Woods system. According to World Gold Council data, official sector purchases exceeded 1,000 tons per year in both 2022 and 2023, more than double the long-term average. This was not driven by short-term hedging. Gold does not offer yield, carry, or credit exposure. Instead, it increasingly functioned as a reserve asset independent of financial infrastructure. Several major institutions played visible roles in this shift. Russia continued expanding gold holdings after access to foreign reserves was curtailed. China added gold steadily, reducing the share of reserves held in foreign sovereign debt. India and other emerging markets followed similar paths. These purchases occurred quietly, often during periods when prices consolidated rather than surged, consistent with long-horizon allocation rather than tactical buying. At the same time, assumptions about global financial plumbing began to change. The freezing of sovereign reserves, the weaponization of payment systems, and growing settlement frictions revealed that liquidity could no longer be treated as neutral or unconditional. Assets held in foreign jurisdictions became subject to policy risk. Gold, by contrast, remained a bearer asset with final settlement outside digital systems, clearinghouses, or correspondent banks. Supply dynamics reinforce the shift. Global mine production has grown only marginally over the past decade, averaging roughly 1 to 2% annual increases despite higher prices. New discoveries have declined, ore grades have fallen, and permitting timelines have lengthened. Most gold ever mined remains above ground, but it is largely held as long-term reserves, jewelry, or strategic inventory, not responsive supply. Meanwhile, price discovery remained dominated by paper markets. Futures and ETFs accounted for the majority of daily trading volume, often exceeding physical flows by orders of magnitude. This created periods where sentiment weakened even as physical demand remained firm. Pullbacks were framed as failed rallies rather than pauses within a structural reallocation. When financial conditions tightened, liquidity drained, positioning unwound, and risk assets corrected, gold did not experience a structural reversal. Central bank buying persisted. Asian jewelry demand remained resilient. Physical premiums appeared in several regional markets, even during price consolidation. The pattern is historically consistent. Gold does not require crisis to perform. It tends to move ahead of consensus when long-term confidence is being adjusted rather than withdrawn. The signal is not explosive upside, but resilience when narratives turn skeptical. From this perspective, gold's rise since 2022 was not driven by fear of imminent collapse. It reflected growing awareness that certain assumptions about debt sustainability, policy flexibility, and frictionless access to reserves are no longer absolute. Markets may interpret that shift as caution. Policymakers may frame it as diversification. History generally records it as preparation. Gold did not advance because chaos was expected tomorrow. It advanced because permanence was no longer assumed indefinitely. and that explains why the move began well before it became obvious.